what a shakeout really is accumulation done by the institutions. So as an example to demonstrate this, if we have an institution Y and they want to own 225,000 shares of a stock, but they're worried they don't want to push the price up too high beyond, in this case, $48. So how does an institution do that? And I've drawn this kind of theoretical chart down here, a little chart pattern showing the chart shows support at the lower end of 45 and resistance up around 55. And as I mentioned, this institution already has a position at 48. So how does an institution, accumulate a lot more stock and not push the price higher? So here we are. This is 48 on the chart. Now, what institutions will do is they will tend to manipulate the crowd, the retail investors. So they know that when a stock is in a range, it's getting support at 45, resistance at 55. So they know that many retail traders will put their stops just below the lows of the range. So you end up with a lot of different orders being placed at $44.90, $44.50. So you get all these orders. So these are all probably a lot of retail small orders. And let's assume that when you aggregate all those orders, it's 100,000 shares that is sitting below the market. So what does an institution do to achieve their objective? Well, an institution would do this. An institution has the power to move the market. The institution would sell 125,000 shares in order to push the price down and break the stock. By pushing the price down and breaking the stock, as you can imagine, all these little stop orders of retail traders are getting ticked off, and they're all become market orders. So what happens as the stock is falling is this institution, after that block of stock pushes things down, starts to buy. They start buying all the stock that has been triggered. And as they buy all the stock that's been triggered, and they start buying more at a lower price below 45, don't forget, when the stock breaks 45, short sellers start to short the stock, thinking the stock is going much lower. So as the institution buys all of these orders and takes all this stock, plus they keep buying, they actually force all these stops to be hit. And as the stock comes rising back up, all the short sellers now are forced to cover their short positions, which creates even more buying. The shorts have to buy, and this institution is buying, and you'll see the sharp recovery. And in that sharp recovery, that is what creates the shakeout. There's a sharp move down, and then just another sharp move right back up. So in this example, just like magic, the institution now has 225,000 shares, and they did it below $48 a share because they got all these shares below 45, and then they bought more shares probably between 42 and 48. So all of a sudden, they now have their position without moving the stock above 48. It's kind of interesting when you take some of the mystery out of a shakeout, but that's mechanically kind of what's happening. So what do we look for in shakeouts? Because we're trying to determine, ultimately we're trying to say, when this stock breaks, is it an institution that's trying to shake out people because they're accumulating stock? Or is the institution breaking the stock because they're running for the exits and there's distribution going on? So two scenarios. One is the shakeout with the V shape, and the V shape is very important in a shakeout, and you want to see the V. So here's an example of a stock that was moving sideways. Here's the shakeout, comes down sharply, breaks the red line, which is the 50-day moving average, and you can see immediately comes back strong and recovers the original buy point. That's a shakeout. That's the V action that we like to see, and the fact that it kept moving higher confirms that it was a shakeout. What we don't want to see is a stock that comes down hard, comes back up to the prior pivot zone, and then kind of rolls back. As soon as it starts rolling back, you need to get out. It's not a shakeout, and this was probably distribution. So this will make a little more sense as we look at some examples. So on the left is Rambus. This is from April of 2023. Stock is right here, formed a little consolidation, and then you can see a sharp move lower, actually breaks through the red line, which is the 50-day. And then you can see this V. There's the V, comes right back Now, the stock comes back strong, and what's really a clue that maybe it is a shakeout is the shakeout. You can see the volume here, but look at the recovery volume. It dwarfs the shakeout volume. So that's that surge of buying of people that were shorting the stock and the institution buying back their position. Came back very strong. You could have made an aggressive buy probably in here, or you could have waited for the original pivot to be recovered, and you could have bought back up in here. But that's an example of a real V-shaped shakeout. Now, on the right side is shift for payments for, again, April of 2023. So again, we have a stock that was in a range. You can see the low end of the range here. We break sharply lower. There's a lot of selling in the stock, and you can see this huge volume day. Now, this stock closed mid-range, doesn't look too bad, but you can see the rally attempt up kind of stalls out. It tries to get going again. It runs into the 50-day, and the stock starts to roll back. The V is not completed. We don't get back up to the pivot level up here. As soon as it starts to roll back, we want to get out because this is really distribution, not accumulation, as we saw in the Rambus example. And you can also look, there was really no buying volume on the recovery. So that's a good template to look at something rolling back, and you probably should get out of the stock.